Good morning and welcome to Momentum Global Matters. My name is Ray Mere and I'm Head of Investment Distribution here at Momentum. With me in studio is my colleague, Kapil Joshi, who's the Head of Momentum Collective Investment Schemes. So Kapil, what do you think of our new three-dimensional studio here?
I think it's amazing, and I love how Momentum Investments has embraced the future with our events in the last 12 months. For all of you watching at home, let me tell you a little secret. None of this is real. Not the plants, not the couches, not the walls, the floors, or the ceilings. Ray, should we show them where we really are?
Why not? For everybody tuned in today, we have an incredible lineup of investment experts from around the world who will be sharing their insights and views about the past 12 months and also the road ahead.
But before we get to our first speaker, just a few things for all of you to note. Not only did we build our new beautiful virtual studio, we thought it also needed a home. You're watching this from our brand new Momentum Investments events website. This website has a couple of really neat features. At the top of the landing page, you will see that we give you access to our agenda, profiles for each of our speakers, and a great way to navigate this conference.
In addition to that, our download section has links to all the presentations, information packs from all our presenters, and links to video content you might find interesting. As we move into the future, this website will continue to grow and become your home for investment information. Our investment specialists are on hand to answer any questions you may have during the event, so please post your questions in the chat box for us to respond to them. If you need any more information regarding our capabilities or investment solutions, please request a callback and we'll get back to you as soon as possible. Kapil, shall we get the show on the road?
Let's do that.
Next up are three experts from the UK who will give us some insight on the market that has been in turmoil in the last year. I'd like to introduce three colleagues from Momentum Global Investment Management. Andrew Hardy and Glyn Owen, who are investment directors based in the UK, as well as Lorenzo Laposta, a senior analyst who's joining us from Italy. Morning, gentlemen, and welcome to South Africa.
Good morning, Ray.
Morning, Ray. Thank you. Good to see you.
Morning, Ray. Thanks for having us.
Andrew, let's start with you. The first question is to you. Is this year's economic recovery fully priced in already?
Thanks, Ray. There's no doubt the markets have come a long way towards discounting the global recovery ahead. However, we think there's still a lot more upside potential left for investors, particularly in those parts of markets that were hardest hit by the pandemic sell-off at the start of last year. We had higher equity exposures in portfolios a year ago than we do today, when valuations were even more compelling. But we continue to believe that equity markets will be the key driver of portfolio returns in the coming 12 to 18 months, and are positioning our portfolios accordingly. I'll talk about where we currently see the best opportunities in a minute, but first, why are we so positive? Well, we're highly confident that the world is on the cusp of an economic boom like few we've ever seen before. This is firmly underpinned by the success of the vaccination program. The benefits of that are being felt disproportionately around the world, of course, but an absolute end to the pandemic and the restrictions on activity and movement that came with it are clearly in sight. For now, among large countries, it's the likes of the US and the UK that are set to recover earliest, because their success on the vaccine rollout is increasingly enabling a loosening of restrictions. The rapid release of pent-up demand will be the key swing factor in the coming months, which markets have increasingly begun to discount since the first big vaccine news over 6 months ago. This has been no normal downturn, though. Savings don't usually grow through a recession. This time they have, though, driven by government stimulus and furlough schemes, keeping people employed in many countries. And of course, the sheer lack of opportunities to spend on holidays, business travel, leisure and entertainment, etc., as well as all the spending indirectly linked to that. It's estimated that total excess savings around the world amounts to over $5 trillion, which represents over 6% of global GDP. In the US and the UK, where furlough schemes have been more generous and lockdowns tightest, the figures represent over 10% of GDP. And that's before President Biden's first $1.9 trillion stimulus package is accounted for, which includes checks of $1,400 to most adults straight into their pockets. Which brings us to this chart and the other factors which explain why the recovery is going to be so strong, the incredible extent of stimulus that's been unleashed. Here, the fiscal and monetary response to this crisis across various countries is shown in red, measured as a percentage of national GDP in each case, and compared to other recent crises. The scale and global synchronization of this stimulus makes this response unlike anything ever seen before. Even the massive bailouts and quantitative easing following the financial crisis is nothing compared to this. However, unlike then, the fabric of economies remains very much intact, and most critically, the banking system's in rude health with very strong capital levels, meaning that key transmission mechanism can be part of the solution rather than the problem. This combination of factors is already leading to much higher consumer and business confidence, and economic activity levels are recovering rapidly. This next chart shows leading indicators of manufacturing activity across most major economies moving sharply higher in the last few months and pointing to strong growth ahead. A figure above 50 represents expansion, and the levels shown here are among the highest seen for many years, if not ever. But the big question mark for investors are around the outlook for policy from here. And again, our view is constructive. We don't see a return to fiscal austerity anytime soon, especially while sovereign borrowing rates remain so low, and with the memories of the post-global financial crisis mistakes still fresh in policymakers' minds. Taxes will rise in time, but that shouldn't be seen as today's problem, especially given it will be those most able to shoulder them that will be targeted across individuals and corporates. Instead, for now, we're likely to continue to see the opposite, more stimulus. President Biden's already working hard on his second and third massive packages, and the rest of the world is to varying extents following the same playbook. Meanwhile, liquidity is abundant and interest rates remain at or close to all-time multi-century lows. This is creating pockets of exuberance, and investors need to be wary to not get caught up in these. But the focus should be on the broad-based overall support for markets, which is unlikely to be withdrawn anytime soon. We expect rates to stay low for the foreseeable future and for liquidity to continue flowing. Indeed, financial conditions in the US are estimated to be at their most accommodative level since 2007. Quite incredible, but highlighting just how rapidly markets are normalizing. Critically, this provides huge underpinning for asset class valuations. If you believe that rates will stay low, then that crudely justifies higher valuations for all risky asset classes. Then if you also factor in that earnings will move higher at the index level, that warrants higher valuations today in anticipation of that. Now, yes, stock markets have delivered very strong returns already over the past year, but that largely represents the immediate recovery from very depressed levels. Many markets fell more than a third, so needed to rise by more than half just to get back to where they were. And the first 8 months of the recovery was driven by the pandemic winners, the stay-at-home beneficiaries like tech companies and online retail. The frequently referenced FANG index in the US, which includes the likes of Tesla, Amazon, and Netflix, outpaced the rest of the global market by 50% over that period. Although on the surface, markets have maintained a consistent trajectory for most of the last 12 months, there was actually a marked shift in early November when the first vaccine news came, and value stocks started to outperform, with an intensity that increased this year to mark the biggest outperformance we've seen for that cohort of stocks for a decade or more, as the so-called reflation trade took hold. And it's that which really underlies the question of whether markets have run too far. In the last 6 months, stocks in hitherto unloved areas like banks, mining, high street retail have surged higher and in many cases have nearly doubled. So how much more does the recovery trade have to run? The next chart, I think, is one useful way of addressing the question. It shows the cyclically adjusted valuation multiples through time for the major equity regions. This uses a longer-term measure of average earnings, which is helpful because it smooths out the huge volatility of the last year. And it shows that most markets are at or around their historical average levels. That's despite the recent recovery I've already discussed in share prices, despite much of the earnings recovery being ahead of us, not included in these numbers, and despite there being a strong case for multiples being much higher than normal today. Consensus expectations are for earnings in the US, which now represents over 60% of the global index, to increase by more than 40% this year. That'll bring these multiples down to even more reasonable levels. Now, the US is one market that stands out as being more stretched on this measure, but that's largely driven by those mega cap tech stocks in that FANG cohort, which now represent nearly a quarter of the S&P 500 index. Valuations do look excessive for many of those, and indeed for a lot of very high growth stocks. But stripping them out, multiples for thousands of other opportunities look more reasonable. But our view is that at the broad country or regional level, there are better top-down opportunities outside the US. Our home market in the UK is one that stands out for us. It's been overlooked and undervalued for years because of the Brexit overhang and the makeup of the market, which is skewed towards lower growth areas like banks, energy and industrials. But with uncertainty over future trade relations largely behind us, and with a sharp global recovery incoming, that will favour more cyclical sectors. So I think the scene's set for the UK to begin a period of outperformance. The same could be said for several other economically sensitive countries, as well as certain sectors. Areas that have been hardest hit by the pandemic, notably listed property and infrastructure, have lagged the recovery in broader markets. For the right prime monopolistic assets, investors are being well compensated in those areas through high dividend yields to wait for the eventual recovery. And given the greater resilience to inflationary pressures and steady cash flows in normal times, we think those sort of real asset areas are likely to be re-rated before long, especially if rates stay as low for as long as is widely expected. But looking beyond these top-down opportunities, there's a lot of variation beneath the surface across all sectors and countries. Stories of disruptive growth businesses and past outperformers represent inherently more comfortable areas to invest. But it's value stocks where the best forward-looking opportunities lie now. The spread in valuations between the most expensive stocks and the cheapest is as wide as it has ever been on some measures. And there's a lot of room for value stocks to exceed what are still low expectations over a reasonable investment horizon. One of many examples I could pick is the auto manufacturers. The long-established businesses like VW and General Motors are on forward PE multiples of about 10 times versus Tesla on 150 times. Value investing doesn't have to mean buying low-quality or high-risk businesses, just swimming against the tide a little in unloved and underappreciated names. I think security selection is going to be more important from here than it has been for many years, which really speaks to the need for an active rather than passive approach. Passive strategies are, by their nature, concentrated in the past winners in terms of stocks, sectors, and countries. They don't have the level of exposure to value stocks that I think investors should be seeking at this point. So, to be clear, valuations are not obviously cheap across most asset classes, and there's relatively high valuation risk in areas such as government bonds and high growth equities. But broad equity market valuations are not particularly high versus history, especially considering the economic outlook and policy backdrop. And there are plenty of opportunities for active investors. Volatility will likely pick up throughout the rest of the year, compared to the past 12 months, which under the circumstances have been remarkably benign. But I'd encourage investors to manage those risks through diversification and maintaining a long-term investment horizon, rather than trying to time short-term moves in markets. Don't lose sight of the huge recovery ahead and the opportunity for long-term gains that it provides.
Thanks, Andrew. I wonder how much of this money from the US stimulus checks is ending up in the cryptocurrency market. In fact, Glenn, a lot of people are worried about this extra liquidity in the market. So how can one tell whether the world markets are starting to run too hot?
Well, it's extraordinary, Ray, that within 12 months of the world slumping into its steepest and deepest recession since the Second World War, we're asking the question, when's the economy going to be running too hot? Recovery is on the way, and it's going to be like no other in pace and scale. But the nature of the recession, an exogenous shock followed by swift and enormous policy action, has left the productive capacity of economies largely unscathed, while in aggregate, households and businesses have built up substantial excess savings. The shock was unusual too, in that it hit both the supply and demand sides of the economy. Demand collapsed and supply chains were dislocated. Activity levels everywhere plunged and inflation sunk into negative territory. Now, there are material implications in all of that as we enter the recovery phase. The disruption to supply chains will take time to return to normal. An increase in capacity is not an overnight task. Building a new semiconductor foundry takes up to 2 years. Developing a copper mine, clearly much longer. Additional constraints would arise if supply chains are reconfigured to prioritize security of supply over cost. As the surge of pent-up demand meets restricted supply, the result is higher prices. On top of that, the base effects of falling prices in the second quarter last year and the worst of the pandemic, they'll fall away, and inflation is going to spike for that reason alone. Little wonder then that the risk of an inflation surge, something that hasn't troubled investors in the past 20 years, has become topical. Will the coming rise in inflation be transitory, or will it be persistent and trigger a response from central banks to rein in ultra-loose policy? Now, we believe this is the key to judge whether the economy runs too hot. It's going to largely determine the durability of the recovery and the performance of financial markets. And it'll be the US where all eyes should be turned. Aside from being the largest economy with the world's reserve currency, it's at the forefront of the vaccination rollout, turbocharged by President Biden's huge fiscal packages. And with a central bank that's implementing extraordinarily loose policy and prepared to allow the economy to run hot following its policy shift to average inflation targeting. And the impact of that change in policy late last year, incidentally, shouldn't be underestimated. What it means is that because inflation has been running below the Fed's 2% target for quite a number of years now, the Fed can run above 2% for quite an extended period before it feels the need to tighten policy. Now, those huge injections of liquidity that you referred to, Ray, earlier on, they're an underpinning to markets. Any signs of withdrawal would ring alarm bells. The Fed sees the rise in inflation as transitory, and it's intent on keeping its foot on the pedal, but markets could begin to doubt the Fed's resolve as the higher inflation numbers come through. Now, the scale of what has happened in the past 12 months is shown on this slide. It shows the size of the Fed's balance sheet, which reflects the bonds it's bought in its quantitative easing program. That's expanded by $4 trillion in the past year. And that's fed through to the money supply, up over a quarter, and at $20 trillion, not far short of 100% of GDP. That's a lot of liquidity and a lot of potential stimulus. How quickly will the surge in demand eat into spare capacity and result in shortages? Well, there's already evidence of this in key areas like semiconductors and certain materials, leading to forced production cuts while supplies rebuild. The standout feature of markets in recent weeks has been the surge in commodity prices, oil, metals, agricultural too, taking the rises over the past 12 months to 60, 70% more in some cases, as you can see from this slide here. Commentators are already talking about a new commodities super cycle. In the latest Purchasing Managers survey in the US, the prices paid component was at its highest for 13 years, with inflation of prices across most supply lines and businesses citing difficulties in attracting and retaining labor. Another key question is whether the huge liquidity provided by the Fed will ultimately feed through into inflation. This proved not to be the case after the financial crisis, despite massive liquidity injections, but circumstances are very different now. Monetary loosening in the past year and fiscal stimulus packages have been on an altogether different scale to those following the financial crisis, as Andrew showed on that slide earlier on. And this time, there's no return to fiscal austerity. Furthermore, banks were crippled by the financial crisis, and weakened balance sheets meant that lending was curtailed. Now the banks are in good shape. Balance sheets are strong, and they're willing and able to lend to support the recovery. Money supply, which reflects the amount of liquidity in the economy, is expanding in the US at its fastest rate in decades, as you can see from this slide here. And that has often been a lead indicator of inflation ahead. We see a return of inflation as the biggest risk factor in markets. If investors begin to believe that the inflation rise will be persistent, bond yields could move materially higher. The yield on US Treasuries is, in effect, the world's discount rate. A rise in that discount rate would have global ramifications, not least in emerging markets, potentially undermining all risk assets. As you can see from this next slide, which shows a range of inflation indicators in the US, inflation has picked up from last year's lows, but at this stage, it mostly reflects a return to a degree of normality. It's what comes next in the months ahead that will be more testing. We know that inflation is corrosive for savers. It erodes purchasing power, damages the real value of savings and wealth, and would have far-reaching implications for the construction of portfolios. The outcome is by no means certain. Output could rapidly respond to the surge in demand and keep prices in check. Longer-term constraints, demographics, digital disruption and competition, new technology such as AI, they could all bear down on inflation. But after years of low inflation, it would be complacent to assume that the trend will continue. Globalization, which has held down inflation over the past couple of decades or more, could well have peaked. Governments are giving greater emphasis to redistribution and regulation, and reconfiguring of supply chains could all push up costs. While core price measures are still subdued, all the forward indicators point to a significant rise in coming months. The producer price index in the US, you can see it on the slide there, is already at a decade high of over 4%, and this will feed through to consumer prices before long. A critical figure to monitor will be forward inflation expectations. These have moved up significantly from the pandemic lows, but so far only to the broad range which they've been in for most of the past decade. The Fed has the tools to deal with a persistent rise in inflation, but deploying those tools would be damaging for the economy and markets. Letting the inflation genie out of the bottle is a lot easier than putting it back in again. For the first time in many years, the risks have shifted away from disinflation and towards the upside. And these risks really should be carefully considered when building portfolios. We'll be scrutinizing developments. Headline consumer prices will be less important than core price measures, which strip out the more volatile components like energy and food. They're a better guide to underlying inflation trends. The Fed's preferred measure of inflation is core personal consumption expenditure, which to date remains within target. Perhaps most worrying would be if price rises feed into real wage growth and into inflation expectations, as this could well signal an early end to the Fed's ultra-loose policy. Now, I'm not trying in any way to be alarmist about this, simply realistic given the extraordinary conditions triggered by the pandemic and ensuing recession. I'm not suggesting for a moment a return to 1970s style inflation, and indeed the inflation pickup ahead could well prove to be transitory. But the balance of risks has changed, and we need to recognize that in our portfolio decision-taking. With the risks ahead and the uncertainty of the outcome, portfolio diversification is more important than ever. Balancing assets which offer protection against inflation, equities which benefit most from the cyclical upturn, those with pricing power, infrastructure, property, inflation-protected bonds, gold, and other real assets, with more defensive assets which would perform well in a lower inflation environment. Things like quality equities with consistent revenues, government bonds, and other income-producing assets. The key message is diversification in the months ahead is going to be more important than ever.
Thanks, Glenn. Lorenzo, the last question is for you. Investors are focusing on what they know, but what are the tail risks that aren't receiving enough attention?
Well, Ray, I think the currently investors are very concerned about a few things: the length and economic of the way out of this global pandemic first. And the most common worries I can think of are about maybe speed and effectiveness of vaccine rollouts, new virus variants, countries' reopening plans, pent-up demand, economic recovery. Of course, the evolution of monetary and fiscal policies with all the consequences on inflation, on interest rates, and more generally, asset prices. And this is all very important, of course, but there are other risks that I think we should be worrying about too. Number one is the lack of creative destruction. Today, the correlation between economic growth and default rates is low, and it's much lower than it used to be in the past. And that's just a consequence of 20 years of intervention from authorities that, whenever needed, and especially during the most recent COVID crisis, they have been keeping more companies afloat by reducing the cost of borrowing, by offering government guarantees, by injecting capital in a few other ways. Now, this has been great for those companies. It's been great for bondholders, but not so great for economies overall, because this has allowed many unprofitable companies to stay artificially alive, mostly to avoid systemic crashes. Now, this lack of creative destruction represents a risk over the long run, because those unproductive companies that are being kept alive effectively are the same companies taking capital and labor away from more efficient businesses. And ultimately, this damages overall performance and economic profitability. To give some numbers, nowadays 1 in 4 companies in the USA is unprofitable. 1 out of 4 is currently earning less than they have to pay out as interest on their debt. In the late 90s, so a bit more than 20 years ago, it was only 1 in 20 companies in this situation. Looking forwards, for default rates to revert to historical mean, I think we'd need substantially higher real yields, but that is unlikely to come through anytime soon. The second risk that I think is underappreciated is the average person's equity positioning. According to the American Association of Individual Investors, who run a monthly survey on asset class positioning in people's portfolios, the current average allocation to equities within the US is around 70%, having risen strongly over the past 12 months. In the last 30 plus years of survey, the average equity allocation has been 61%, with the top value ever registered 77 at the height of the tech bubble in the early 2000s, and the bottom being 40% or so just after the great financial crisis. So, compared to history, we are today not far from the top. Now, people's allocation to equities is a consequence of many things, of economic outlook, perceived upside potential, but also recent past performance and opportunity set in other asset classes, like bonds, for instance. Equity allocation is not a problem by itself, but the risk behind that is that flows do have an impact on asset prices, and when investors have their pockets almost full of equities, the risk is more on the downside than it is on the upside. So a disappointment in growth, a hiccup in earnings, or simply a price correction could trigger substantial outflows, that in turn would put further pressure on stock prices. The third underappreciated risk, in my opinion, is China. 1.5 billion people, $14 trillion GDP, growing at 6% per annum. China has been for many years the engine of global growth, and more recently, their tech giants, names such as Tencent, Alibaba, Meituan, or Pinduoduo, to just mention a few, they've grown massively and they have provided global investors with spectacular returns along the way. And like most new disruptive business models, those companies have operated largely unchecked so far. But in the back end of last year, the Chinese government stepped up and trying to rein them in whilst protecting consumer rights on areas such as personal data, privacy, and anti-competitive behaviors, etc. The government is now issuing antitrust rules, it's fighting monopolies, and it's regulating the use of personal data within those platforms. For instance, last year, the government stopped Ant Group's IPO. They investigated and fined Alibaba. They fought group buying platforms. And these are only the first elements of what can only be the end of the wild and free era for those tech platforms. And this is not only a risk for those names, but is also a risk to the growth engine that's been driving capital to China in recent years, and it's a risk to the wider economy too. The last risk I can think of is the democratization of finance. Over the past few years, technology has made financial services available to virtually everyone. Now, financial markets and investment options that once were a VIP area reserved to professionals only, now they're available through a click of a button on your phone. It's all very easy. There's plenty of platforms where retail clients can buy stocks, bonds, currencies, and even options at very low cost with just a few clicks. And that's pretty great. But this is not without its share of risks. One risk is obviously to the users themselves, who might be simply buying highly leveraged instruments like futures or CFDs without maybe fully understanding the risks behind them and the potential for losses that come with it. Also, fintechs have almost made a game out of trading with their simple interfaces and flashy colors. Millions of people around the world, they gather on social networks, they share views on stocks and spend actual money based on what they read on a forum or what Elon Musk tweeted about an hour ago. Think about what happened with GameStop earlier this year. I heard of people gathered on a forum called Reddit. They managed to push GameStop's price up by 1,000%, that is tenfold, and then back down to almost where it started from, all of that just in a matter of days, without any fundamental reason behind. They simply did it because they could, because it was fun, it was a social activity almost. And some of them made big money, others had big losses. And similar things could be happening right now with cryptocurrencies. It's really hard to forecast sometimes. Which brings us to the second risk. And this time it's not for people, but it's to financial markets themselves. And it's your usual battle between investment and speculation. If one believes that the primary objective of financial markets is that of efficiently directing capital from people who want to grow their capital to businesses who need capital to grow, then these wild mass behaviors are certainly a risk to markets' integrity.